Hello, you are welcome to our financial markets course. So this is session 2 of unit 1. So still under the overview of financial markets and institutions and interest rate fundamentals, we are going to talk about the structure of financial markets. So by the end of this session, we should be able to distinguish between bond and equity markets, the primary and secondary markets, the money and the capital market, as well as explain foreign exchange, mortgage, and derivative markets. The last, you should be able to explain internationalization of financial markets. So we'll start by looking at the direct and indirect. So when we talk about direct finance, it's a situation where borrowers do business with lenders without any intermediaries. Okay, so for example, and a land business where sometimes you have to go through middlemen in order to get to the real owner of the land, and you realize that even in dealing with this middleman, it comes with costs. The direct finance means that borrowers meet directly with their lenders, so you get a personal touch with the person you are going to borrow from without any intermediaries. So in other words, surplus spending units get to buy financial instruments that are claims to the resources of deficit spenders with no middlemen. So in simple terms, for direct finance, no middleman or there is no intermediation with direct finance. We'll also look at indirect finance, which is obviously the opposite of direct finance. So with indirect finance, they are saying that borrowers secure funds from lenders through financial intermediaries, such as the banks, insurance companies, and other financial institutions. So here, realize that the key difference between direct and indirect finance is the middleman or financial intermediation. So due to the fact that indirect finance comes with the advantage of financial intermediation, we want to highlight the benefits of financial intermediations. And as I have stated earlier, some of these financial intermediaries include banks, insurance companies, and financial institutions. So a perfect example within the banking sector is when you go to the bank to borrow money, you don't know who the money is for. All you know is that you are taking money from the bank, you are borrowing from the bank. So the bank at this point is a middleman or serves as an intermediary between you, the borrower, as well as the person lending the funds to you. So we'll also want to look at the concept of debt and equity markets. So here, financial markets can be classified into either debt or equity markets. So with the debt markets, we are saying that they are markets for the issuance and purchase of securities that promise payments of fixed interest periodically and payment of the principal amount at the end of the specific period. So in simple terms, we are saying that with the debt market, it's a common place where people purchase financial securities, and you're not just purchasing the financial security, but there is an actual promise to pay an agreed and specified interest rate, and this interest rate is paid periodically as well as the principal, and all these payments are made within a specified period based on the agreement which is made. So firms that use debt instruments enjoy interest tax shield but also face high bankruptcy risk if they default in payments of interest rates and principal. Okay, so firms that go with the debt or operate on the debt market have to face high bankruptcy risks, in the sense that there are times that they may not have the ability to issue those securities to their customers, but also they enjoy the benefits of interest tax shield, since based on the definition we learned that there's a promise or there's an agreement for a stated amount of interest to be paid periodically. And here we are getting to know that this payment is agreed. So you pay the interest as well as the principal amount. We also want to look at equity market. So unlike the debt market, the equity market is the market for the issue and purchase of securities that, even though do not promise a periodic payment term. So unlike the debt market where there's an emphasis on payments within a specified period, the equity market does not operate in that way. So with the equity market holders are entitled to residual dividends, unlike the debt market where the payment terms are clear. So you pay the principal plus a fixed interest rate. Also, in the debt market, there are maturity periods. So any maturity period within 1 year is known as the short term. So between 2 to 5 is referred to as the medium period term, and the long term spans from more than 5 years. So that is it with the debt and equity market. We'll also look at the primary and the secondary market. So the primary markets are markets where financial securities are traded for the very first time. So in the primary market, investors deal directly with the company that is issuing the security. So the emphasis here is that in the primary market, securities are traded for the very first time. So the secondary market, on the other hand, is a market for the subsequent trading of financial securities that have already been issued to the public through a primary issuance. So any security that is traded beyond the first time is known for its trading on the secondary market. So the secondary market offers the opportunity for existing shareholders who want to disinvest and potential shareholders who want to join the ownership of a firm to achieve their objectives. So it could be that you traded on the primary market and you weren't happy with the security you got. You can come to the secondary financial market and disinvest as well as join any other security portfolio that you are interested in. So in this sense, the primary financial market or the primary market grants the opportunity for securities to be traded the very first time. You know that there are people that want securities on the first time we announce, but they might not be making the right decision. I hope that is why the secondary market is available, so that we are given the opportunity to reconsider our decisions as well as consider other portfolios we may have ignored in the first option, so that we'll be able to make maximum use of our resources. So an example of the secondary market includes the stock exchange or the over-the-counter market. So in Ghana, the Ghana Stock Exchange serves as a major secondary market for securities such as bonds, stocks, mortgages, just to mention a few. We'll then consider the money and the capital markets. So, the money markets refers to financial markets for the trading of short-term securities, while the capital markets are markets for trading long-term securities. Just as we have different investors' abilities, and as we've also stated earlier, the financial markets is very well regulated. So to accommodate the fact that some investors may want to trade for a very short period and others may want to enjoy the long-term benefits due to the fact that they may not need the capital or their funds at the moment, the financial markets has made a way for traders who want to trade on short-term securities. So those who want to trade on short-term securities or have short-term maturity periods in mind will move to the money market so that that need will be achieved. Also, those who enjoy long-term investments will now move to the capital market where they can trade on longer securities or longer term securities and then gain the benefits that accrued from long-term investment as well. So examples of short-term securities include treasury bills, commercial papers, and fixed deposits, just to mention a few. But on the long-term securities, we have the bonds, the preference shares, and then the equity shares. So the classification of financial markets into money and capital offers surplus spending units and deficit spending units the opportunity to get investment vehicles and funding options that meet their preference investment or funding lifespan. We also want to look at the foreign exchange and the mortgage market. So, a foreign exchange market refers to a market designated for the trading of currencies in order to facilitate international business. Realize that even though we are in Ghana, there are times that we need the US dollar, the pounds, and other foreign currencies to facilitate our trading. There are times that people may have to make payments of their fees in euros, pounds, and all those things. So the financial markets creates the avenue for foreign exchange markets where you are able to trade on other currencies or engage in international business. So in Ghana, the market is dominated by banks, forex bureaus, corporate institutions, governments, and individuals. We then want to look at the mortgage market. So when we talk about a mortgage, it refers to a long-term loan granted to acquire a real estate. So as we've stated that a capital market helps in the trading of long-term loans, a mortgage will be on the capital market. So the mortgage specifically is a long-term loan which is granted for anyone who is interested in real estate. So here we are saying that the market that makes loans for acquisition of properties in terms of real estate readily available is known as the mortgage market. So the mortgage market could be primary or secondary. So key market players in the primary market include mortgage brokers, mortgage bankers, and other financial institutions. So the mortgage market could be primary or secondary in the sense that the mortgage market could be primary or secondary in the sense that investors could come to the primary market to trade on the mortgage loan for the first time. This is what makes the mortgage market a primary market. And realize that in the secondary market, some investors may bring their funds back and then will grant the opportunity for other investors to come for it. That is what makes the mortgage market both primary and secondary in the same line. So we want to continue with a derivative is a financial institution whose value is derived or determined from the value of an underlying instrument in the spot market. So we are saying that any financial instrument whose value is derived from another instrument in the spot market is known as a derivative. So common examples of derivatives common examples of the underlying instruments rather include the stock, the bonds, the commodity, interest rates, and as well as the market indices. But the example of derivatives are the options, the futures, and the spot. And the market for trading derivatives is known as the derivative market. So we are saying that here the options, the futures, and the swaps, which are derivatives, their values are derived or determined by underlying instruments, which are the stocks, the bonds, commodity, and then as well as interest rates. And we are saying that the derivative market could either be it could either be exchange traded market or over the counter market. We then want to look at the internationalization of financial markets. So internationalization of financial markets is a process of ensuring that there's cross-border financial flow of financial products and is made available to borrowers and lenders across national geographical boundaries. Just as we have the US dollar, the pounds, and other currencies within the Ghanaian market. Internationalization of financial markets has made all these things possible. So we are saying that even here in Ghana, even as you are here in Ghana, it is possible for you to trade on other stock markets. And this is made available through the process of internationalization. So through internationalization, you are able to trade on other foreign exchange markets outside of your home foreign exchange market so as to benefit in terms of the interest that accrues on the other financial markets. So the basic driver of internationalization is innovation. And through internationalization, the main idea is that financial markets are able to get better, to mature, to grow, as well as be competitive in that respect. And we also want to look at the euro currency market. So we are saying that an euro bond or euro bonds are international bonds that a government or a large company sells to investors in the foreign currency for a fixed period. So we are saying that if the government of Ghana sells to any investor or sells anything at all to any investor in a different currency at a fixed period, that particular market or that particular transaction is known as an Eurobond transaction. And we are saying that an euro currency is any currency that is held in a bank outside of the country in which the currency is a legal tender. That currency is known as an euro currency. So here in Ghana, the dollar, the pound sterling, the naira, all these are euro currency because they are held in the Ghanaian bank, even though they are outside our legal tender. We know that for Ghana, our legal tender is the Ghanaian cedi. So any other currency which is held outside or which is not recognized as our legal tender, but we trade with it, is known as an euro currency. So the market for trading this currency, this other currency, is known as the euro currency market. All too soon, we've come to the end of session 2 of Unit 1, and in this session, we've learned that financial markets have various classifications. So we've learned about the financial markets having classifications such as the primary and the secondary, the debt and equity, the money market, the capital market, the mortgage market. We've also learned about the derivative markets, and we ended with internationalization, which is driven by innovation. And the main idea behind internationalization is for growth and maturity of financial products. Thank you. Oh boy.